Okay, let's dive in. Imagine this, staking your entire future, maybe even your house, on a flower bulb.
Yeah, it sounds pretty wild, doesn't it?
It really does. Welcome, everyone. We're talking about the 17th century Dutch Republic, specifically around 1634 to 1637. This is the backdrop for what we call Tulip Mania.
Right, that famous period where tulip prices just went absolutely nuts, sky high,
Crashed spectacularly.
just as fast.
Now, the story most of us probably know, the really dramatic one, comes mainly from Charles Mackay's book from 1841. Extraordinary popular delusions and the madness of crowds.
Ah, yes, Mackay. He painted this picture of, well, total chaos, everyone ruined, from the richest merchants down to, as he put it, the lowest dregs of society.
Exactly. That's the popular version.
But, and this is really interesting from the sources of that popular story, it's, let's just say, heavily exaggerated, maybe even largely wrong.
Oh, okay. How so?
Well, modern historians, people like Anne Goldgar, Mike Dash,
Yeah.
they've dug into the actual records, the archives. And what they found suggests it wasn't this nationwide economic meltdown Mackay described. It was much more contained.
To contain. Meaning?
Meaning it mostly involved a kind of smaller circle of wealthier merchants, maybe some skilled artisans playing the market, not a society-wide collapse.
Okay, so Mackay's dramatic tale isn't quite the reality.
Not really, no. The Dutch economy itself didn't tank because of tulips.
So that itself is fascinating. Why does that story, the dramatic, inaccurate one, stick so hard, even today?
That's the million guilder question, isn't it? It taps into something about how we view markets, maybe greed, irrationality.
Yeah, maybe it's just a better story.
Could be. Compelling narratives often win out over, well, dry facts.
So that's really our mission for this deep dive, right? Use the sources we have to unpack what likely did happen, why the bulbs became so valuable in the first place, how the crash unfolded, and, importantly, why this particular story, this myth almost, persists.
Exactly. Understanding the gap between the story and the history tells us a lot about, well, finance, human behavior, and maybe the power of a good tale.
Okay, so let's get into it. Tulips. Why tulips? They were pretty new to the Netherlands then, weren't they?
Relatively new, yeah. Imported from the Ottoman Empire. And this was during the Dutch Golden Age, a time of incredible wealth and burgeoning trade. These flowers became instant status symbols, exotic, vibrant, different, perfect for the newly rich merchant class to show off.
And it wasn't just any tulips, right? There were specific kinds that were really prized.
That's right. The most sought after were the broken tulips, the ones with these amazing sort of flame-like patterns, multicolored streaks.
They sound beautiful.
They were visually stunning. But here's the irony. We know now those patterns were caused by a virus, a mosaic virus.
A virus, so they were actually sick.
Essentially, yes. The virus weakened the bulb, made it harder to propagate, reliably reproduce, and you couldn't predict if the offspring bulb would have the same pattern.
Wow, so the very thing that made them valuable also made them diseased and unpredictable.
Precisely. Added a whole layer of scarcity and, frankly, gambling for the growers and buyers.
And the prices. The sources mention some truly mind-boggling figures.
Oh, absolutely bonkers. A single bulb of Semper Augustus, that's a famous, now extinct variety, was reportedly valued at, like, 10,000 guilders.
10,000 guilders. What did that mean back then?
That was more than a grand house on an Amsterdam canal, enough to feed and clothe an entire family for, well, many years.
Yeah.
Half a lifetime, maybe?
Just incredible. There's that story about someone offering a townhouse for just 10 bulbs.
And the offer was turned down.
Rejected. It's hard to even process that.
It really is. And it highlights a key point from the sources.
Yeah.
This complete disconnect between, the intrinsic value of a flower bulb, a sick one at that, and its market price.
The price wasn't about the flower anymore.
Not at all. It was about scarcity, novelty, speculation, and crucially signaling wealth. Conspicuous consumption in its purest form. The bulb was just a token.
Okay, so the object itself becomes detached from reality. But how did the trading actually work? Tulips only bloom briefly.
Good point. You can only physically trade the bulbs for a few months of the year. This impracticality led to a major innovation, or perhaps complication, the emergence of what we now call a futures market.
Ah, so trading contracts for bulbs they didn't even have yet, promising to buy or sell later at a set price.
Exactly that. People were essentially betting on future prices months down the line, making deals for bulbs that were still in the ground.
And this market, was it regulated? Formal?
Not really, and that's critical. This wasn't happening on an official stock exchange. A lot of this trading took place informally, often in taverns.
In taverns? Seriously?
Yep. which led to the nickname wind handle.
Wind-handed.
Literally wind trade. Because, nothing physical was changing hands, just promises, contracts written on paper, trading air.
Trading air, wow. And were there, like, safeguards, deposits, margin calls like we have now?
Well, that's the other crucial part. Mostly no. Traders often paid a small fee, sometimes called wine money, maybe 2 or 3%, to seal the deal. But there wasn't a consistent system of requiring initial margin money up front, or mark-to-market margin, where you adjust the deposit daily based on price changes.
Okay, so none of the standard stuff that helps manage risk in modern futures markets.
Largely absent, or at least not systematically enforced in the wind handle, this lack of sort of financial guardrails just poured fuel on the fire.
So anyone could jump in.
Pretty much. You saw merchants, sure, but also craftsmen, ordinary people hoping to get rich quick. They didn't need huge capital up front, just the belief prices would keep rising.
Which pushed prices even higher.
Exactly, a self-feeding frenzy. Some sources say contracts were changing hands multiple times, maybe up to 10 times, in a single day. The price became totally about what the next person would pay.
Not about the bulb at all anymore.
Not even slightly. It was pure speculation on price momentum.
So you have this powerful financial tool, the futures contract, but it's operating in this Wild West environment. No rules, no safety nets.
And that's another huge insight the sources give us. Financial innovation without proper regulation and risk management, it can go sideways fast. Instead of making things efficient, it just amplified the speculation. Price discovery went out the window. It just became a bubble inflating.
Turning risk management tools into risk amplifiers.
Perfectly put. It all peaked, apparently, in the winter of 1636, 1637. Prices for some rare bulbs just went vertical. Some reports say up 1,100% in just 1 month.
1,100%.
In a month.
Crazy numbers. The pace was frantic. Everyone wanted in.
Until they didn't. What triggered the crash?
It seems to have started quite abruptly. February 1637, apparently in the city of Harlem, buyers just stopped showing up at auctions, or they refused to honor the contracts they'd signed. The bids just vanished.
Any particular reason why, then?
It's hard to pinpoint one single cause. Confidence just evaporated. Some accounts mention an outbreak of bubonic plague around that time.
Ah, the plague. Yeah, which might have unsettled people, or maybe, as some sources suggest, it just provided a convenient excuse for buyers to walk away from deals that suddenly looked terrifyingly overpriced.
Why to get out of these massive potential debts?
Possibly. But the core issue was the collective realization. These prices are insane, and the trust underpinning the whole wind trade just broke.
And prices collapsed.
Plummeted. Almost overnight, the sources say. Created a domino effect, as anyone holding contracts or bulbs tried desperately to sell.
But it wasn't, as we discussed, a crash of the whole Dutch economy.
No, that's key. The wider economy was still strong. This was a collapse within that specific speculative tulip market, a sudden collective loss of faith in those particular assets and contracts.
It really underlines how much these bubbles are about psychology, doesn't it?
Absolutely. It's all built on shared belief, this often irrational confidence that prices will go up forever. Once that belief shatters, the whole thing falls apart incredibly quickly. Shows how fragile confidence is in purely speculative markets.
So the aftermath. People were left holding worthless contracts, right? Facing ruin.
Many were, yes. Especially those who got in late or leveraged themselves heavily. They faced crippling debts. Financial ruin was definitely real for the participants.
And the legal system, how did it handle trying to enforce all these wind trade deals?
It basically got overwhelmed. And the sources show courts largely refused to enforce these contracts.
Refused? Why?
They often classified them as gambling debts, not legitimate business transactions. Which maybe tells you something about how extreme it had become.
Gambling debts. But these were contracts, people had signed things. Was that fair or just practical to avoid mass bankruptcy?
That's a great question. Probably a mix of both. The informal tavern deals, the lack of actual goods changing hands for months. It did feel like wagering to many observers and judges, but also, yes, the sheer scale of potential ruin was enormous. Enforcing every single contract could have caused chaos, impacting far more than just the speculators.
So the courts were kind of stuck between strict legality and, well, social stability.
Exactly. They were dealing with something new, these financial instruments pushing boundaries. It really highlights that challenge. Where does legitimate commerce end and pure gambling begin?
Did the government step in?
Eventually, yes. They passed measures allowing contracts made after a certain date, November 1636, I think, to be essentially canceled if the buyer paid a penalty, like 10% of the contract value.
Sort of a haircut, then? A way to limit the damage?
Right. It helped draw a line under it, stabilized things somewhat, but it was obviously too late to prevent the crash itself.
And the perception of tulips changed overnight, I assume.
Completely shattered. They went from the ultimate status symbol to, well, a symbol of folly and ruin. Fell right out of fashion for a long time. So if we pull back, what are the big takeaways here from the sources?
Well, first, that huge gap between actual value and market price when speculation takes over.
Definitely. Then the danger of new financial tools, like that win-handle futures trading, without proper rules or understanding of the risks.
Right, and the power of psychology, herd behavior, confidence, fear in driving these booms and busts.
And finally, the sheer difficulty of cleaning up the mess afterwards, especially for the legal system trying to figure out what's fair when contracts become so detached from reality.
And it brings us back to that initial point about the narrative, Mackay's story, the exaggerated one about mass ruin.
Yeah, it clearly shaped how we remember Tulip Mania for centuries, much more than the more complex reality found in the records.
It just shows how a dramatic story, especially one that fits our ideas about crowds and madness, can really stick, doesn't it? Way before modern media amplified everything.
Absolutely. Narrative is incredibly powerful in shaping economic memory.
So, thinking about today, for you listening, why does digging into this nearly 400-year-old story matter now?
Well, understanding it gives you, I think, a really valuable lens for looking at markets today. You see echoes, perhaps, in cryptocurrency booms, meme stocks, other asset bubbles.
Yeah, how narratives drive investment, how information or misinformation spreads.
Exactly. Makes you question the stories you hear, doesn't it?
Yeah.
How collective belief forms, how easily value could detach from fundamentals. It's about spotting patterns, maybe.
So here's something to chew on, drawing from that legal mess afterwards.
Okay.
How does that struggle back then, the courts trying to decide if these were real debts or just gambling because the prices were so unreal? How does that reflect the challenges we face today, regulating markets where assets, maybe digital ones, maybe complex derivatives, seem totally disconnected from any, tangible value?
That's a really potent question. When does speculation become gambling in the eyes of the law or regulators today?
And tied to that, what's the individual's responsibility? If the state, like in Tulip Mania, ultimately might not enforce every deal or bail everyone out when a speculative bubble bursts, how much risk should individuals take on themselves when chasing those potentially huge wind handle profits? Where does prudence end and folly begin?